The financial world is experiencing something we have never seen before. A simultaneous explosion across every major asset class on Earth. The S&P 500 has rocketed 40% in just 6 months, one of the fastest and most powerful half-year rallies in modern history. Gold is marching toward $4,000 an ounce, its highest price ever recorded. And at the same time, Bitcoin is surging. Its market cap is blasted through $2.5 trillion, rewriting every chart on the screen. Now, the headlines make it look like unstoppable optimism, but under the surface, a question is forming. Are markets really that strong, or is the U.S. dollar just collapsing? Because while asset prices are soaring, the dollar index is sinking, down over 10% year to date, on pace for its worst annual performance since 1973, the same year the U.S. fully abandoned the gold standard. This isn't just a bull market. It is a global rush out of fiat and into hard and digital assets. A full-scale monetary migration, and it is accelerating. Last Saturday night, Bitcoin shattered records again, surging past $125,000 per coin. Its value is now an astonishing $2.5 trillion. That is larger than the gross domestic product of most nations on Earth. And yet that looks small next to gold's new dominance. Gold just hit its 40th record high of 2025, reaching a total valuation of $26.3 trillion, more than 10 times the size of Bitcoin's market cap. For over a decade, economists have argued that gold was a barbarous relic. But today it is clear. The world is losing faith in paper currencies and racing towards stores of value that can't be printed, devalued, or defaulted on. The shift has begun. And once it starts, it does not stop. And the quiet, dark horse in all of this is silver. Often overlooked, long dismissed, it is suddenly the best performing major metal on Earth. I did a video on this about a month ago. Silver is up over 60% year to date and now worth $2.7 trillion globally. Silver has now joined gold and Bitcoin in the top 10 largest assets on the planet. Now, this trio, gold, silver, and Bitcoin, has historically risen when markets crash. They're the lifeboats, the safe havens that investors run to when risk hits. But this time, something extraordinary is happening. The lifeboats and the yachts are rising together. So even as defensive assets skyrocket, stocks are on an absolute tear. The S&P 500 has added a mind-bending $16 trillion in market cap in just 6 months. The only thing close to this was the liquidity-fueled explosion of 2020 and 2021, when rates were crashing down and the Federal Reserve was printing trillions and pumping it in to prop up the economy. The NASDAQ 100, it just locked in 6 straight months of gains, something that's only happened 6 times since 1986. And the old Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Meta, Google, Tesla, they are unleashing over $100 billion every quarter in CapEx. It's capital spending, most of that going to power the AI revolution. So this is not retail-driven FOMO. This is corporate America going all in on the next industrial revolution, even as the currency system that built it begins to wobble beneath their feet. So in short, both safe havens and risk assets are exploding together, and this is a once-in-a-century convergence. This defies every rule in the book. Safe havens are supposed to move opposite of equities. Stocks rise, gold falls. When fear spikes and stocks come down, that's when gold and Bitcoin and silver shine. But in 2024, those old relationships collapsed. The correlation coefficient between gold and the S&P 500, meaning how much they move together, hit a record 0.91, meaning the two moved in the same direction 91% of the time. That is not diversification. That is convergence. And it is screaming one very clear message. This is not a normal bull market. This is a global portfolio shift, one where the goal isn't chasing returns, it is escaping currency destruction. So what's actually happening? We are witnessing a massive, just all-encompassing rush into assets, and every kind of assets: stocks, crypto, metals, real estate, even fine art, farmland is going up. And it all stems from one thing. The Federal Reserve has started cutting rates into rising inflation. They are loosening policy while prices accelerate and the labor market weakens. That's like stepping on the gas pedal when the engine is already overheating. The U.S. dollar is paying the price. It is down, as I said, 10% for the year, on pace for its worst performance in 5 decades. Just since the year 2000, the dollar has lost 40% of its purchasing power. And it is not just Americans who are noticing this. The world's central banks are too, and they are voting with their balance sheets. They are buying gold and diversifying out of dollars at a record pace. And here's where it gets wild. The Fed is cutting rates into this even as headline inflation runs at 4%, as core PCE is above 2.9. This has not happened since the 1990s. You see, they're no longer fighting inflation. They are surrendering to it. This is not a pause. It is a structural policy shift, a quiet admission that growth now takes priority over stability, that jobs are more important than pricing, and that the system cannot handle high rates for very long. Now, markets have figured it out. They're not betting on transitory inflation. They are betting on permanent easy money. A world where central banks quietly let prices rise to keep the illusion alive. That is the only explanation that makes sense. Because when your safe havens, your gold, your crypto, your silver, when your risky assets, when your commodities, your real estate, when they all rally together, you are no longer in a cycle. You're in a regime change. Market-based inflation expectations for the next 5 to 10 years are surging. And in my opinion, they're nowhere near what we're actually going to see. Investors are saying loud and clear, inflation is not going back to 2%. The Fed can issue all the hawkish statements at once, but the bond market has moved on. Long-term yields have broken free. In my opinion, the Federal Reserve is rapidly losing control of the bond market. I believe in the next 10 to 12 years, when the Fed raises or cut rates, no one's going to care because we no longer look to them for guidance in interest rates. The free rate will no longer be that which is charged on government debt because no one's going to want government debt. And once the market loses faith in, once they no longer believe the central bank, that's the moment monetary control ends. Now, at the same time, a second explosion is happening, as we all know, the AI revolution. This is, without a doubt, the biggest technological transformation since the birth of the internet, and it is reshaping everything. Corporations are investing trillions in data centers, chips, automation, infrastructure. Entire industries are reinventing themselves in real time. So what you have now is this dual force hitting at once. You've got a monetary shift where money itself is losing value, and you have a technological revolution where innovation is compounding value faster than ever before. And together, what these forces are doing is creating a historic rush into all assets. Not speculation, self-preservation. And it is accelerating faster than almost anyone expected. Now, here's the dark side. Not everyone is benefiting. As this everything boom unfolds, the wealth divide is widening faster than at any point in U.S. history. The bottom 50% of Americans now control just 2.5% of total wealth. Meanwhile, the top 10%, those who own stocks, real estate, hard assets, control nearly 90% of everything. And every rate cut, every dollar printed, every new bubble, it all widens that gap. We are watching a generational wealth divergence in real time, and it is accelerating with every Fed meeting. So that's the takeaway. We've officially entered a new area, one where money loses value, assets inflate, and wealth concentrates at the top. This is not your grandfather's bull market. This is not business as usual. It is a monetary reset, fueled by inflation, innovation, and the slow motion collapse of the U.S. dollar. Those who adapt early, who move out of cash and into scarce, productive, or disruptive assets will capture the upside of the century. Those who hesitate will be left behind. because this is no longer about beating the market. It is about escaping the system before it redefines wealth itself. Now, if you haven't already done so, hit the subscribe button down there in the corner. I want to keep you abreast of developments in the stocks, metals, and currency market to do everything we can to both grow and protect your wealth.